So, as I'm sure all of you are aware by now, bank stocks have been in free fall recently, with even the biggest, most popular bank stocks out there crashing by giant amounts. And it's really all coming, of course, from the collapse of SVB Financial, Silicon Valley Bank. And so, in today's video, I just want to quickly explain to you what happened with SVB and why it's affecting other bank stocks now. But more importantly, I want to share my personal opinion with you on whether I think any of the big bank stocks are a buy now on the dip, considering the cheaper valuations and the higher dividends from their stock prices going down. And of course, these bank stocks have always been known for having those attractive, valuations and of course attractive dividends. So I'll share my thoughts on all of that. And if so, if they are a buy on the dip, I'll also let you know which ones I think are the safest or most attractive among them. Having said all that, please just do me one quick favor though, guys. Please try to understand that this is a new and developing and very complicated situation that we have here, which could potentially get much worse or stabilize. It's very difficult to predict exactly how everything will play out, especially in the short term. So as always, please do your own extensive research and make your own decisions. I'm only sharing with you my personal opinion. And if you're buying or selling stocks based off what someone says on YouTube, then you shouldn't be investing in stocks in the first place. And that's just me being honest with you. I'm not trying to be mean or anything like that. I'm just being honest with you. Please do your homework. Please do your own research. And try to understand that this is a very complicated situation. But anyway, if you still want to hear my personal opinion on all of this, then let's go ahead and dive straight into the video. And thank you for all your support, by the way. It means a lot to me. But let's go ahead and jump into it. Okay, so I'll try to keep this really short and simple. But what essentially happened with SVB is that the bank has now officially collapsed and shut down, marking the largest bank failure since the financial crisis of '08, which before the collapse, SVB was the 16th largest bank in America. So that gives you an idea of just the magnitude of all this. But despite being a very large and well-established bank for 4 decades, SVB's downfall started with some very poor investment decisions that they made in recent years throughout the pandemic. And what you need to understand about them is that just like its name implies, Silicon Valley Bank, it was a very popular bank in Silicon Valley among tech startups. In fact, it was actually the largest bank in Silicon Valley, the most used one. And because of the pandemic, many of these tech startups were IPOing, with 2021 being a record IPO year. And at the same time, tech companies were experiencing explosive growth because of the lockdowns, where more people were at home and relying on technology. And also because of the trillions of dollars that the government was pumping into the economy. As a result, SVB saw a gigantic influx of deposits and cash being stored in their bank, which sent the stock skyrocketing up to nearly $800 a share. Well, just like any other bank would do with an influx of deposits, SVB decided to invest that money in hopes of making even more from it. Unfortunately for them, though, they decided to invest very heavily in government-issued bonds, specifically long-dated ones that have several years out until maturity. And normally this wouldn't be a very risky bet since they're backed by the government, and even if their prices go down, all you have to do is wait until maturity to recoup your losses. Well, 2 things happened in specific, though, to SVB that turned this into one of the worst investment decisions possible. For one, coming off of the pandemic, technology companies saw their growth plummet, with IPO proceeds collapsing by 94% in 2022, and not a single deal raising over $1 billion after 15 of them raised more than that in 2021. But on top of that, the economy started to collapse, with these tech companies earning less money and laying off tens of thousands of workers off. And as a result, they decided to start withdrawing their money from the bank and obviously depositing, much less too, if at all. And because of all the reckless stimulus that we pumped into the economy that left us with record high inflation, the Fed decided to fight it by raising interest rates at one of the fastest rates in history. And when you raise interest rates, the price of bonds go down, which not only has been destroying the economy, but it also made SVB's investments worth much less than they were before, which again, it would have been fine if they could have just waited until maturity, but SVB couldn't wait because they were bleeding money really fast, and it all resulted in a large bank run and the eventual collapse of SVB altogether, which of course sent the stock crashing, which also got delisted today after they filed for bankruptcy, so I'm guessing the stock will be worthless now. But it's not just SVB's stock that has suffered. The fear that this could turn into another 2008 financial crisis situation has now sent shockwaves across the entire sector, with even the largest banks feeling the pain too, as Citigroup fell over 12% this month, US Bancorp fell over 30%, Wells Fargo fell close to 20%, Bank of America also fell close to 20%, and then JP Morgan Chase is holding up the best among them, but still fell over 12% as well. And from their highs, they're actually down way more than that too, which I'll show you in just a second. But the question now is, where do we go from here, and are these bank stocks a buy now on the dip? Well, for sure their dividends and valuations are going to be getting much more attractive now as the stock prices go down, which I will show you here in just a second. But the more important question is, are these stocks even safe to invest in to begin with? Or are they at a big risk of collapsing just like SVB did? Well, there's always going to be that risk with bank stocks, and in my opinion, the risk will increase dramatically the smaller the bank is. But when we talk about being too big to fail, that is something that I do feel applies to the big banks. And specifically for this video, I focused on the 5 big banks to keep things a little simpler, and these are the most popular bank stocks out there as well. And I want to show you really quick how they just simply don't have the same level of risk as SVB did. In fact, I don't even think it's close. First of all, these are all much larger banks with much higher liquidity and much lower exposure to the bond investments that hurt SVB. Chase, for example, leads the pack for both deposits at over 16% market share and total assets at over 18% at a whopping $3.3 trillion. Bank of America comes in second, Citibank at third, Wells Fargo at fourth, and US Bank at fifth, who still held more than double the amount of SVB at over $500 billion. More importantly though, the Big Five invested much less of their assets into bonds as SVB did, who held almost 130% of bond losses last year as a percent of their total tangible equity, meaning they couldn't even cover those losses. And while Bank of America is a little higher at over 50%, they're still much better diversified throughout many different sectors instead of just having, practically all of their exposure to the riskier Silicon Valley tech like SVB did. Plus, they have huge liquidity because of their size. And especially in the case of Chase and Citigroup, their bond loss percentages were only around 15%, which is super low. So it's very unlikely that they would experience the same exact problem that SVB had. On top of that, their size allowed them to be more conservative with their investments, as they held much more liquidity in cash than SVB did. In fact, most held close to 20% of their assets in cash alone, while SVB was in the single digits at just 7%. And Wells Fargo is really the only other one there that is a little riskier at just 11%. But it should also be noted that these banks are much more heavily regulated ever since the financial crisis, and specifically these ones because of their larger size. When you think of the term too big to fail, well, the US government really doesn't want these banks to fail, and that's why we have much stricter regulations on them and even put them through stress tests that ensure they have enough capital and liquidity to survive downturns. All of these, by the way, easily pass those strict stress tests. And personally, the only bank stock that I've ever invested in myself is JP Morgan Chase because of how well run they are, which you might recall that not only did Chase run their own stricter stress tests during the pandemic that showed they could even survive a giant 35% recession with huge unemployment, but even during the financial crisis of '08, Chase was one of the few banks out there actually taking over smaller banks that were failing in order to help themselves, but also to support the economy. Which, by the way, don't be surprised if some of the big banks start doing that again this time around too. In fact, I wouldn't be shocked at all if Chase actually saw an increase to their business going forward because of so many people feeling scared to leave their money in the smaller banks that they're worried might fail, and so they start parking their money in the bigger banks like Chase that they feel are much safer and too big to fail, which again is a sentiment that I do share with them. I feel that these big banks are too big to fail, and I think America is heavily reliant on them. I think they can't afford to allow any of them to really collapse, and I just don't think there's a whole lot of risk of that to begin with, especially given the different data and information I showed you already. So do I think these stocks are a buy on the dip? Well, they're certainly starting to look much more attractive, and I'll show you which ones I think are the most attractive among them in just a second. But just keep in mind, though, this is more so from a long-term perspective, because in the short term, well, there's still all kinds of other risks that you have to factor in too. The economy is still in horrible shape. We might be going into a recession this year, which would bring down the entire stock market, not just bank stocks. But of course, that would damage banks a lot too. But longer term, I do think the economy will recover, and I think that we are slowly bringing down inflation. And the good thing too is that we have this really big bag of ammunition here with the high interest rates, that even if we go into a recession, which is not guaranteed, but even if we go into a recession, well, we have ammunition of high interest rates that we can start to lower, and that would boost the economy and probably send the stock market soaring again. In fact, that's exactly what we did right after the last financial crisis, and we ended up seeing one of the biggest bull runs in history. So that could also be another potential scenario here that plays out as well. So there's many different things that could happen, but from a long-term perspective, yeah, I do think these stocks are starting to look pretty attractive here. In fact, let me show you their valuations, their financials, and their dividends, and let me compare them amongst each other to show you which ones I think are looking the most attractive among them. Now, looking at their stock prices from the top, Chase has held up the best, but is still down close to 30%, while the rest are all down around 40% or more. And that's raised their dividends to some very attractive levels, with Chase, Bank of America, and Wells Fargo all above 3% yields, Citigroup at a very nice 4.6% yield, and then US Bank is the most attractive of all at above 5%, which is very high. And yet, most still have pretty good payout ratios at around 30% or less too, with only US Bank a little higher at 51%, but even that's still not that bad. And actually, when looking at consecutive growth years for the dividend, US Bank is actually the most committed of all, being the only one in the double digits at 12 consecutive years of growing the dividend. The others are pretty good too though, especially Chase and Bank of America at almost 10 years, but Wells Fargo is pretty low there at just 1, since they recently cut it multiple times after having huge business problems and scandals of their own that was really hurting their business and their financials. Speaking of financials though, Wells Fargo is bouncing back a little this year with revenue growth of 8%, but I don't really count that because they've been struggling for years now. And the real story, I would say, is the monstrous 20% growth for US Bank due to their acquisition of Union Bank, which I highly agree with, because it's not only making them a larger overall player, which does make them safer too, but it's also giving them a ton of synergies within the business. And then the other thing I notice here too is the very strong high single-digit growth of Chase and Bank of America, despite them already being the two largest, which not only do they have the larger size, but they also have the highest return on assets, which is a common way of measuring a bank's performance and profitability. Citigroup is a bit of a disappointment though, as they not only have the lowest revenue growth, but they also have the lowest return on assets as well. Valuation wise, they're all similarly cheap at less than a 10 forward PE ratio, but Chase is the most expensive because of the higher quality, and US Bank is surprisingly the cheapest despite actually having a pretty good business and the best dividend, probably because of their smaller size. Okay, I know I just threw a ton of information at you guys, so let me just kind of simplify everything really quick with an overall ranking from best to worst based on my own opinion. At number 1, I'm putting Chase. I see them as the clear all-around winner. They have amazing performance, the strongest business, they're the safest option. They have still a pretty good dividend and valuation even for their size. And yes, it is the most expensive technically among all of these, but I feel you get what you pay for, and that's very high quality. And that's why it's the only bank stock on the list that I actually own myself. I'm putting them as number 1. Next, I would put US Bank at number 2. Yes, it is the smallest of the big 5 banks, which you could think of as having a little higher risk because of that, but they're growing a lot thanks to the acquisition of a Union Bank, And because of their smaller size, they are able to grow too. And even though they're the smallest, they're still large enough to where I feel that they're probably too big to fail. They're also the cheapest stock, and they have the most attractive dividend at over 5% yield, which is mouth-watering. In fact, I'm actually heavily considering buying US Bank stock myself, and I may buy it soon. I haven't pulled the trigger yet, but I am very tempted. So US Bank stock, the most all-around compelling option, I feel, and I put them as number 2. Then Bank of America at number 3. And Bank of America is always going to be like a solid all-around choice, but I just feel that they're the weaker version of something like Chase. And so I would never find myself actually buying Bank of America stock because I can just buy Chase, which is very similar, but I feel Chase beats them on virtually all aspects. Maybe just Bank of America is a little cheaper, but besides that, everything else, Chase takes the win. So I feel Chase is the better option, so I'll put Bank of America down at number 3. Then at number 4, Citigroup, who has an attractive dividend, but everything else is pretty mediocre, so I'm just not all that interested in them. And then I put Wells Fargo at number 5, who I feel is just the weakest or kind of lowest quality among all of these, and they've dealt with scandals and other issues. I just don't feel very safe investing in Wells Fargo myself. So that's how I would rank these, but I'd love to hear what you have to say down below. Do you agree or disagree with anything I said today? Please let me know, guys. I'm really interested in hearing your opinions on all of this, and we can have some conversations down there. But thanks again for stopping by, for watching the video. I really appreciate all your support. I hope you're all doing well, and I will catch you in the next one, my friends. Take care, everybody. Bye-bye.